Going live. All right. All right. Hello and welcome everybody to today's Think Outside the Bank direct funding webinar. This is where we take 30 minutes during the lunch break and we really take some time to go over one of 27 different funding programs that we help business owners get. Because what is it every business needs, right? People, property, and money. And mostly money is typically what we see as the issue here. So my name is Joseph Smith. I'm one of the wise guys in ties. In fact, I'm the money guy when it comes to this partnership, and Mr. Fleming is known as the property guy. We do a lot of real estate investing together, and what we noticed when we started this business several years ago was that we needed access to money, and we learned a lot of advanced financial strategies, and it's been a huge blessing to us. We've raised over $1 million in funds, and we've helped many other businesses do the same thing, because people come to us and say, "Hey Joseph, hey Ray, how did you do that?" And so we're like, well, we did this, we did that. And then so we just got inundated so much with so many people's questions that it took on a whole life of its own. There's now so many different, literally hundreds of different clients that we have where we help people build their business credit. Thanks for that, Ray. I always like hearing an echo of myself coming back. That's good stuff. So what we do every week, week in, week out, is we help people build business credit. We help people learn how to do what are called credit banking strategies to reduce their debt on their personal side. And we also help people get into real estate investing. So pretty much the three different areas where we focus on helping people. And today, we're really taking a look at how to get directly funded for your business. So again, I'm Joseph Smith, part of the Wise Guys in Ties. Our contact information is right here on your screen. This is how, if you want to get in touch with me and schedule a free 30-minute consultation, we have our phone number, email address, and our website. On our website, which is great, you can go and right off the page, go right into our calendar and select which time or appointment best suits you. So let me get some disclaimers out of the way here. I want you to know, first of all and foremost, I'm not an attorney. I'm not practicing any law here. I'm not a CPA. I'm not a fiduciary. I'm not a financial advisor, financial planner. I'm none of that. And nor should you be looking to me for those types of financial expertise. What I am is I'm a successful business owner, and I've been able to achieve a lot of success in business and using these financial strategies that we pass off to you. It's really up to you to do your own due diligence to make sure that what we talk about here today really applies to you. So I encourage you to hire those type of professionals in your life and work with them and make sure that you make the best choices possible for you, including financial ones. All right, so let us move on. A lot to discuss, short time to do it. What are we talking about today? Well, I wanted to really cover, so each week we're going to be going over one of 27 different ways that you can get funded for your business, but that is funded outside of traditional lending. So this is why we call this Think Outside the Bank, because when you need money, where do you go? You typically go to the bank. And the bank, what do they want to see from your business? They want to see that your business has cash flow, that you have credit, and that you have collateral. In our book that we wrote, the Entrepreneur's Playbook for Building Business Credit, we talk about the 4 C's of lending. The 4 C's being your cash flow, and then credit is broken up into 2 of those C's, because you got your personal credit and you got your business credit. Those are 2 separate credits. And then you have collateral. And typically what banks want to see from you is that you have all 4 of those and that they're all 4 doing great. And so for a lot of folks we talk to, if that's not you, then you don't qualify for any type of bank loan. So therein lies the problem. So what we're going to look at each and every week is a different strategy. So you might tune in and you might find, well, that doesn't work for me. That's fine. Keep coming back every week because we're going to go over a lot of different strategies for a lot of different businesses. And if you're a marketer or you have a business where you're looking to raise capital, you should pay attention every week because regardless if any of these businesses or these financial strategies that we talk about apply specifically to you, you should be at least able to see or know somebody that this might apply to. And then if you're looking to raise capital, you know how to help a business owner get access to funds that they then could potentially invest with you. All right. So when we break down lending into its different components, the cash flow, the credit, and the collateral, with the banks, you need all of those. What we are looking at are secondary type of lenders, private lenders, different types of funding that is available to people through secondary channels. This is perfectly legitimate ways to get access to funds, but most of us have been conditioned to think that the only place where we can find money is from a bank. And so this is where, when you start going to a secondary lender, they have different criteria in place. Criteria being that sometimes they don't care if you have any collateral or they don't care if you have credit. And in this case, if you have cash flow, and if you only have cash flow, then there are people who are willing to lend in this space. Now, over the next few weeks, I really want to talk a lot about cash flow types of funding. And it breaks into about 3 different tiers. I think we all like to get actual corporate credit, right? We want those big, huge lines of credit for our business. That would be amazing, phenomenal. We also like loans, and we in short, term-based loans for a small specific period of time. And then there's also, so those break down, so tier 1, tier 2, tier 3. So tier 3 being, say, the best if you absolutely qualify and you meet all of the requirements, you want to get those business corporate lines of credit. And then if you don't qualify for the corporate lines of credit, if you can get a term-based loan, that would be tier 2. And then tier 1 would be MCAs, which would be merchant cash advances. And that's a revenue-based type of lending that we're going to talk about today. When people work with us, the wise guys and ties, and we work really hard to do a very thorough financial blueprint to get a good snapshot or a picture of where your business is at. Do you have cash flow? Do you have credit? Do you have collateral? And then based off of where we're at with those, we also want to look at how you are with your bank management. And we're going to get into this as much as I can, but keep in mind that we're always going to try to find you the most money for the longest period of time for the best terms and the rates possible. That's what we're always attempting to try and help our clients. Now, Wise Guys and Ties doesn't actually do any lending itself, but what we do is we have an extensive network of where we plug into with our loan officers that we partnered with. They will refer you to different types of lenders that they have relationships with that we can help find you the money, right? And that's what this is about, finding people the money. So as you see here on your screen, we're looking at cash flow based funding. So what is cash flow? Cash flow is the amount of money that you have coming in to your business that exceeds your expenses. The total amount of money that comes in is called your revenue, as you may or may not already know that. So sometimes this is also called revenue-based lending because the approvals can be based off of the total amount of money coming in, even if the majority of that money is going to service the overhead or the expenses for the business. So the more cash flow that you have, the more profits that you're showing, then the more that you can qualify for with this type of lending. So we're really looking at a tier 1 lending product here, revenue-based lending product. This is where if we find somebody's had some challenges, then this is where we really begin to help them. So So okay, listen. So if your personal credit is bad, or you have no established business credit, maybe there's been a bankruptcy in your past. I mean, that's a reality for some folks, but there's been, a few years and it's been completely discharged. Then we're going to have to really move towards tier one type lending. And so usually when you're getting tier one type of lending, as I'm terming it tier one, it means that it's going to be for a very short period of time, a low amount of money and a really high interest rate. The only good news about it is this is how you get your foot in the door, and you start using these programs, and the more you use it, then the better terms you're going to get, and the more you're going to qualify for other types of lending programs. So then you can move from tier one to tier two and then up to tier three. But you have to establish yourself and prove that you are fundable. So with revenue-based lending, typically what this is a situation or scenario when somebody's looking for an MCA, a merchant cash advance, is they need some money for marketing. They've got to buy a new piece of equipment, or maybe they've got to repair a piece of equipment so that they can continue to make money. And the way that breaks down, and I'll get into this, but let me finish this slide here. That's really important, is because your bank management is very key to qualifying for this, because they want to see consistent deposits. And when I say they want to see consistent deposits, I'll show you on another slide what they're actually looking for. But they want to see a lot of deposits coming in, and they're not looking for transfers from one of your bank accounts to another. They're actually looking for checks or different types of income that's coming into your business. Positive cash flow. So a positive ending balance at the end of every month, right? They want to see, they would really like to see no NSFs, but a lot of times what we see, especially with certain types of businesses that don't get, you might have a trucking company and you get paid like $10,000, and this is great, but you don't get paid till, every 2 or 3 weeks. So then you might have some NSFs that happen, and then all of a sudden you got the money that comes in, and then you have to pay everything. So there is some understanding, as long as it's not out of control, it's not happening too much. But they want to see your average daily balances being positive, because that's what they're going to base the payment off of, is usually your average daily balance. So what are they looking for? How do you qualify? Well, they're looking a lot of times for so whenever you're applying for any type of funding, people, they want to see, if a lender could, they would love to see your tax returns. But the great thing is with revenue-based lending, we don't need to see tax returns. We don't need to see 3 years. We don't even need to see 1 year's worth. We just have to, because this is revenue-based lending, they just need to see bank statements, not bank summaries, but the actual full bank statement for just as little as 3 months. If you could just provide 3 months, the last 3 months of your bank statements, full bank statements, that's the minimum necessary to require to get approved. Now, if you can provide 6 months, 12 months, right, that's always better, right? The more that you can provide, the better. But what's great is a lot of us are at different levels. If you just had a startup, like you just recently started your business and you can't provide 6 to 12 months worth of bank records, but you've got a lot of positive cash flow coming in, or revenue coming in, well, then there's a way to get access to some additional funds. So let's take a look at revenue cash advances. I want you to know that when we're talking about this type of money, what we're really looking at is, this is expensive money. It's really hard to, like, why would anybody go for this? Again, I was trying to create the scenario where if you really need money and you know that you need somewhere around like $5,000, $10,000, $15,000, and if you could spend that and put that into your marketing, or if that purchased a new piece of equipment, or it was able to help you bring on, say, a new temporary or part-time staffer to increase, so that you could increase your workload. This is the purpose of this type of lending. It's you borrow some money to help you go and make money right away. What this should not be used for is, obviously, you don't want to use this money to lend it out to other people. That's a big no-no. Nobody would. They won't lend to you if that's the case. You don't want to take this money to just go pay some bills, right? Because this is a very expensive type of money that you're borrowing. So you need to look at this as a way that you're investing in your business to increase your revenue. Okay, so I talked about how this helps you get your foot in the door, establish your track record. Another thing that's really great is that if you are consistently making your payments on these type of loans, usually halfway through the loan, they're going to offer you a better rate, offer you a chance to get another loan. So the more you use this type of lending, the better the rates get. So and it does get to be more reasonable. This is fast money. So a lot of other lending programs, especially when you go through the bank, like say the SBA program, oh my goodness, that could take months, right? This is fast. As long as you meet the minimum requirements, the money is there. This is low paperwork. There's not a lot of documentation that's required for this. Your bank statements, that's really all that they need to see. As long as you can legitimately prove that you are pulling in the revenue, that's good. And another thing that's important is your personal credit. A lot of time they are going to take a look, and most lenders do look at your personal credit, but this lending is not based off of your personal credit. You can have as low as a 500 credit score, and that's fine, right? Because it's not really based, the money that they lend to you is based off of the revenue that the business is bringing in, not your personal credit score. So for some people who have had some issues that have happened with their credit, maybe you took your great personal credit and you invested it in your business, and now your personal credit sucks, right? I get it. So this is why credit isn't as big a deal for getting these revenue-based loans. So on the screen there, it says all that's needed is 6 months of bank and merchant statements. We actually are working now with one lending source that only requires 3 months. So, but again, the more bank records that you can provide, the better it is for you. So they're looking for stability. They want to see consistency, and that's really important when it comes to revenue-based loans, is the consistency. So if 1 month you bring in 10,000, the next month it's 45,000, the next month it's 8, I mean, they're going to want to see consistency. So you're think about, like, how much can you get? It's typically going to be based off of the average monthly income is. That would be your total loan. They're really looking for people that are bringing in $10,000 a month in gross revenue. So that would be $120,000 a year. Now, maybe that doesn't all come into your business. Maybe you have a seasonal business, maybe ski rentals, tax prep, things of that nature, where you bring in a lot of money, but only for a short period of time. Well, then the lender's going to want to not see 3 or 6 months. They're going to want to see a full year to see how that, how long that season lasts that you're bringing in the money, and basing how much they're going to lend you off of that. So, rule of thumb: if you're bringing in about $10,000 a month, and that's pretty consistent over the last 3 to 6 months, then you could expect to get about $10,000. If you're bringing in $20,000 a month, well, you could expect to get about $20,000. That's pretty much a rough guideline there. Now, again, that's also based off of if you have no current debts. If your business does have a lot of debts and you're paying on because you've got some vehicles and equipment, and so you're making payments, those are factored in as well. So it's sort of looking at like your income to debt ratio there. So you've got your revenue that comes in, but how much of that is going towards servicing existing debt? Well, then if you're bringing in $20,000 a month, but you've got $10,000 a month servicing debt, well, then they won't give you $20,000 at that point, but they would give you 10, right? So there's a lot of these different factors. And when you apply, it really it's a very simple process. You're filling out a 3-page application that I've filled out before. It takes like 45 seconds. Very basic information. Upload your bank records, and you get an answer or a reply within 24 hours. So it's very easy, very fast. Loan amounts equal to up to 12% of annual revenue. That's what I just talked about. They might, on your very first time coming out, want to set you up with daily paybacks. And that's specifically if you're a retail type of business where you do have daily income that's coming in. Now, if your business is not set up that way, then they will set up a weekly payment schedule. And again, they're going to look at your business model. I mean, if you only get paid monthly, then they'll make it a monthly payment. But they're always going to try to make sure that they set up their first priority is to set up a daily payment, then weekly, and then monthly. And so also the way you pay these back is through a automated direct withdrawal from your business bank account. And that brings up another point. You have to have a business bank account. You can't have a personal checking account and take advantage of a revenue cash advance. It's just not going to work. That's not how these things go. So you have to have a business bank account. That's crucial. And then what type of income do you have coming in? Let's say you use PayPal or you use some other merchant processor and you run all these cards. If that is 100% of where the money's coming in from, then this program isn't for you. There's a different program that works in those cases. But what we want to see is if you do have income coming in from some credit card payments, and you do have some checks coming in, like they'll take it all into account. Okay. So we're looking at the term of these anywhere from 6 to 8 months. Actually, I've even seen if you really have very poor financials, they're probably the first time out will just make it about a 3-month type of a loan. A small amount, like maybe 5,000 is all they'd lend you for 3 months. And it can go up longer, but typically once your financials start getting stronger and let's say you do qualify for an 18-month or 36-month merchant cash advance type of loan, well, if you qualify for that, then you're probably going to be able to qualify for the next tier up, a term-based loan, or maybe even a line of credit. And when we get there, then the rates are so much better that we really don't want to use the revenue cash advances anymore, just because it's so expensive. So keep in mind that this is, for a lot of people, the best option. If you have a business and it's making money and you are pinched for cash, a merchant cash advance is a legitimate way to get about 1 month's worth of your money that you bring in through your gross revenue loan to you, and then you pay that back over the next, say, 3 to 6 months. And so each time you do this, they'll extend your term. They'll give you a lower interest rate. They'll lend you even more money. So they could, in many cases, lend up to $500,000 as long as the revenue that you have coming in backs that up, right? We have noticed that people who utilize this program continue to use it over and over again because, yeah, the first time was really expensive, but then it really starts to come down. The interest rates really start to come down, the loan amounts start to go up, and the length that you can hold the money out grows as well. So the more you use this program, the better the rates you get, right? So you can see right there, anywhere from 10 to 65% interest. And you're like, Oh, that's so expensive. That is very expensive. You need to make sure that you do the math, because if you're going to your first time out, uh, borrow money at 65% interest, that's quite expensive. However, if you're up against the wall and you know that if you can just take 10, 15,000, $20,000 and invest that into your marketing, like I said, or maybe purchase some new equipment or bring on another employee or two, and that investment is going to, over the next few months, bring in so much more for your business, then it makes sense to do this. Then the next time you borrow, you're borrowing at a lesser interest rate. Maybe instead of 65, this next time they come around, it could be 40, 45. And and I'm not saying you start at 65 either. I mean, if you're, I mean, it all depends on how much cash flow you have, and how, and how bad your personal credit score is. There's a lot of offsetting factors. So the more cash flow you have coming in, the better your credit score, the lower your interest rate is. So, um, and they're always looking at your bank management skills. Do you have a lot of NSF fees? Do you have a lot of negative balances, right? Well, the more risk that the lending source is going to take, then the higher the interest rate they're going to charge. Now, here's a really great thing for those who are business owners. The fees and the interest on these type of loans are 100% tax deductible. So even though it does cost you a lot of money, this is the kind of thing that you can write off. So if you have a forward-thinking strategy of how you're going to do your finances for this year and what your write-offs are going to be, being able to deduct the fees and interest makes this type of lending a lot more palatable if you look at the big picture of what you're doing. And if you do intend to keep dipping back into this type of lending, let's say you have payroll, and sometimes it's hard to make payroll, especially when you've got payroll tax that comes up every quarter. I get that. So a revenue cash advance is really good so that you can still, make sure all your employees get paid, and then handle paying the taxes or whatever that need to happen. So there's different ways that people that utilize this program, and it works very well in their business model, and it might work really well for you as well. So here are some breakdowns, so you can see the numbers here. Looking for consistent revenue that's verifiable through your bank statements. Loan amounts range anywhere from $5,000 to $500,000. Terms anywhere from 3 to 36 months. When you see the factor there, that's like a daily interest rate, so it can get really expensive. Though the more you use the program, the cheaper that this money is going to be. So this is roughly around 33 to maybe 46% interest. And this is where, if you have enough cash flow coming in and your credit score is 500, no recent bankruptcies, you're going to be able to get approved for this, right? Looking for that consistent bank income. So if you're someone who's like, well, I don't have $10,000 of revenue coming in every month consistently, but sometimes you have a little bit more. And so, I mean, let's take a look at it. I mean, if you're close, if you're $8,000, $9,000 in total revenue, you still might qualify. Again, it doesn't hurt to take a look and see where you're at. So as we're looking at these type of loans, this is just more information. I want you to understand that when you do submit your information, and you fill out the 3-page little online form, and you submit the bank records, what happens is, if you do get approved, they're going to look for, they want a driver's license and a voided check from the business bank account, and then you're going to get funded within the next 2 or 3 days. I mean, it's really that fast. 1 day to apply and get approved, and then another couple of days to actually get funded. So that is, another strength of this program, is how quickly you can get access to the funds. So I'm just looking through my notes here. I want to make sure that I give all of this information to you so that you can make an informed decision if this is going to be a good a good viable option for you. We have a number of clients that use this, and this actually is a stellar way to get access to 1 month's worth of your revenue real quickly, so that you can then invest it and turn it and make some more money with it really quickly. So just keep in mind that the more you use this program, the better your rates are in your term you're going to get. That's really what we're looking for here. So, we're talking about how many deposits are actually needed. Well, they're looking for at least eight different, like maybe you've got direct deposit from some merchant services that you're using, credit card payments, like I said, like a PayPal coming in. You got some other checks coming in from other businesses or individuals paying for your services. And the reason why they want to see that is because they are only, your lending source is only going to get paid back because you have cash flow coming in. If they see that you really only have one source of income that comes in, well, what happens if that goes away? Well, then they're not going to get paid. So that's very important for them to see that there's these multiple sources that are all coming in, so that they know if one were to go away, they still can get their money back. So non-sufficient funds, as long as you have 3 of them or less in a month, then that's going to be fine. Negative balances, which do sometimes happen to businesses that have a lot of money coming in and a lot of money going out, right? And it can happen when something's due before a check clears. Happens all the time. As long as that doesn't happen more than 3 times in a month, you're good. Again, goal is at least the minimum to see $10,000 in gross revenue coming in. And I keep trying to emphasize gross revenue, because a lot of people feel like, well, I only make like $2,000, $3,000, $4,000, $5,000 a month of profit. We're not talking profit. We're talking about the total volume of income that's coming in. Once you start paying all your bills and your overhead, what's left over becomes your profit. They're looking at the gross number, the total amount of revenue coming in, which a lot of businesses can easily qualify on that. And then, of course, they want to see that your personal FICO score of the owner is at least 500. Actually, we had somebody just a month ago get qualified, and they had a 480. So again, when you see these requirements up here, these aren't hard fast. These are general guidelines. And if one area of your finances is strong, so a 480, but bringing in $20,000 a month in revenue, okay, there's there's a way that you can offset some of these requirements. We talk about the sweet spot. Well, first of all, when I look at that, if you've been in business for 3 or more years and you have $50,000 a month coming in gross revenue, and your FICO score for the owner is between 600 to 690, I'm going to recommend that you actually wouldn't use this program. I would try and get you into a term-based loan, or maybe even see if we can get a small line of credit. But the point is that, again, when you think about the sweet spot, is getting them, being in a position where if you could get 1 month, if you could borrow 1 month of your average income to your business, and you were able to apply that towards making more money, that's what we're looking at. The sweet spot for a business is if borrowing that money could actually make the difference. Like, some people are sitting there like, we have a truck and we have to ship materials, and the truck breaks down and it's a huge repair. Well, what are we going to do? Well, that's where, hey, well, if I did a merchant cash advance, I could get the money, repair the truck, we're back in business, no harm, no foul. And then pay that back over a 3-month period of time. That's huge. Because some people, something major like that comes up, and maybe they go out of business, and that's not what we want to see happen here. So this is a great program for people who have some of those type of challenges. Now, for all of you on this call, I'm going to wrap up here. I thank you so much for taking time out of your day to be with us. I ran a little bit over, but I want you to know that we are committed to helping your business. And you can get approved for up to $150,000 or more in business credit cards or lines of credit. Just what we want you to do is give us a call. There's our phone number on your screen. You can call us at 888-524-9273. And when you do, you'll be able to schedule a time with either myself or my business partner, Ray Fleming, and we'll help you find which of these different programs works well for you. And if revenue-based lending or merchant cash advance is a good fit for you, let's get you started today. We could get you funded within the next 72 hours. I want to thank you so much for letting us come in, help you today, think outside the bank, right? And we look forward to working with you. I believe next, just in a couple of days on Thursday, you'll be hearing from my business partner, Mr. Ray Fleming, as he helps you learn how to build your business credit and talks about the important steps that it takes so that you can gain access to a large amount of money for your business in a very short period of time. Thank you so much. Have a good night. God bless.